Hi there, it's Chris from WeLet, and I'm just going to carry on from where I left off last week and just go through some numbers as to what it looks like when you're trying to take money out of your own home to use it on a property business. So let's take a look at the numbers, shall we? So how to get equity out of my home? So some questions to ask. How much is outstanding on a mortgage? How much is the house worth now? And you should be able to remortgage to 75% of the new value. Now, in the UK, house prices double roughly every 8.5 years, but for this example, I've used 10 years. So if you were to start with £100,000 house and you paid your 10% deposit, so £10,000, leaving you with a £90,000 mortgage. That is working out at, say, 2.5% would be £400 a month. Now, after those 10 years, the house will be worth 200,000. Your mortgage, which would be 90, would probably be around about 75,000 left after paying off for 10 years. Don't forget your mortgage is loaded towards the back, so the first few years you're paying a lot more in terms of interest as opposed to capital repayment. So if you look at this, you're left with your 200k house, you take 75% out, so that's 75% mortgage, which takes you to 150k, which means at 2.5%, you're looking at about £670 a month for your mortgage. So yes, it's more expensive. There's about another £270 you have to find, but it would mean the difference between 75k to 150k, which means you've got £75,000 potential here, money out, which you can then use for property. Now, in Leicester and Loughborough, 25% deposits for buy-to-lets. Usually that would give you maybe 2 single lets or a 5-6 bed HMO, which is a house of multiple occupancy. So that's when you have more than three or more unrelated tenants in the house. Now, you can do a number of different ways to do this, a couple of different ways for sure. So you can either use your current lender. So if you're tied in with your current lender, you can use them, and you can look to put a second mortgage on to take monies out, or you can remortgage to another lender. Now, obviously, look at fees, etc. You don't want to be tied in. It could be the end of your fixed rate period that you have with your current lender, and you could remortgage, get a better interest rate with the new company, the new lender, and also take out the additional monies which you can use again to buy your buy-to-let house. Now, I would suggest you use a broker. A broker will get you the best mortgage deal. They need to be looking at the whole of market as well. So yeah, you will pay them some fees, usually around £200-300 for fees, but they will search the whole market and get you the best rate available. So that's definitely the way to go. Don't just turn up for your, turn up to your regular bank of 20 years and expect to get the best deals, because that's not going to happen. So what can you do to make sure you get the most money out, or to be able to get any money out which you can use enough to use to get another property? You need to do a few things in the run up to this. So knowing that your fixed rate, for instance, is coming to an end, what you need to do is ensure, because they're going to ask, the bank's going to ask, you need to ensure in the run up, in say the 6 months before, that these things are not happening. So you don't change jobs, you don't change banks, you don't take out any more credit, and if possible, think of things that you can drop, like sort of gym fees and things like that, so you can take those off and reduce your costs. So when they ask for a budget, you can provide them with one where you've got plenty of free cash at the end of the month, and they'll use that, and they'll check your bank details over the last 6 months, and they'll check that. And when they've done that, and with yourself or your partner as well, and they see there's enough headroom for you to pay the additional charge on the mortgage, then they're most likely going to lend. And then that takes you on to the next part. What is a good investment? Where should you go to start with? Maybe not necessarily straight into a HMO, maybe 1 or 2 single let properties. So this is a great strategy to get started, and I'm going to go into a bit more detail next week as to what may be the best way to start once you've taken that money out, how you would go about sourcing and getting a good single let property to start with, or even 2, depending on how much you can take out. So this is just the strategy, and as I said, next week we'll move on to how that might look when you're buying your first buy to let property. Okay, that's enough from me. Thanks, till the next time, bye.